Hello, this is Rich Vessel, founder of Advanced Projections, with our June 2023 economic report. Our reviews for the economic data highlights for May and early June are the following. Employment figures for May came in with another solid new jobs figure, up 339,000, but unemployment moved up from 3.4% to 3.7%. We still expect unemployment will begin to gradually move upwards. At these low levels, the Fed must stay fully focused on inflation, given this as continuing ammunition for further rate increases. Employment is a lagging indicator in the business cycle, so it typically declines after a downturn has begun. Annual CPI inflation through May was announced on June 12th with the actual reported value of 4.0%, exactly matching expectations. However, the core CPI that leaves out volatile food and energy prices was up at 5.3%, and sticky price inflation less food and energy continued high in May at 6%, which is 2% higher than the more general CPI number. A declining producer price index for all commodities also continues to signal a likely recession as commodity prices reflect declining demand and easing of supply constraints. The Federal Reserve declined to increase their Fed funds rate on June 14th, maintaining this key interest rate at a 5.0 to 5.25% range. We had expected them to implement another increase, but new inflation and employment numbers here in June and July may make them go there again at the end of July at the next FOMC meeting. In mid-June, they issued a new set of dot plot projections for 2023 through 2025, and we're still looking for a longer fight against inflation with higher rates than they have previously projected. The continuing hot employment picture is likely to confirm that scenario. The Fed's pause came with a firm indication that they plan to increase rates at least 2 more times this year, unless something extraordinary happens with inflation. Equities markets have gained as much as 20% since the October 22 lows were put in, but recently have hovered around key resistance levels. The S&P 500 has tested overhead resistance around 4,200 and broke through it with the Fed pause. The S&P 500 is now solidly back in bubble territory. The bond markets reveal that smart money is still paying more attention to the Fed's signals and pronouncements. As we said last month, there was no real reason to worry that Congress would crash the quality of U.S. debt instruments by playing chicken with the debt ceiling. The sensible people in Washington averted the complication, came to some rational compromises, passed an agreement, and then, of course, went back to business as usual. There are now no AP indicators showing green and only one. The AP stock indicator continues to skirt the boundary between red and yellow. It may return to full-on red by the end of June due to its bubble reentry. So here are the underlying economic details. Year-over-year consumer price index increases and tight labor markets continue to affect many aspects of the economy. General expectations out just ahead of this May's CPI announcement were for 4%, and it came in at 4.0%. The Federal Reserve paused in its series of rate increases, but promised 2 more this year, as the underlying sticky inflation numbers are not coming down as rapidly. Unemployment or employment has not yet returned to a negative trend, and consumers are still spending record amounts on credit. The Bureau of Labor Statistics reports that unemployment continues to remain well below 4% over the past 11 months, now at 3.7%, with new job gains in May of 339,000. We had expected those gains to dwindle in the first few months of this year, but there is still no evidence of it yet. We are expecting to see a more significant trend of layoffs begin sometime in the summer of 2023, and May had 440,000 new unemployment claims. Old jobs are beginning to decline, in other words. Below, we show in the report, the written report, a table from the BLS with the employment statistics for this month comparing it over the last quarter and 1 year ago. That's the Household Data Summary Table A, which is in our usual report. This currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so, right along with their 11 rate increases in the March 22 through May 23 timeframe, and within their last available FOMC meeting minutes. Look for continued small increases when the Fed FOMC returns with its next steps in the middle of summer. Their recent rate increases came in 25 basis points below our expectations, but based upon the coincidentally issued reports, we do not expect any delicacy or wavering on their part here in the middle of 2023. Expect at least one 25-point bump this summer, most likely at the end of July, and perhaps as much as 50 points if they lend more weight to the still climbing credit card debt, employment, and sticky inflation values. Now, we've included in the written report again the quarterly table issued in the Fed's June 23 report, showing exactly why to expect continuing Fed hawkishness. Note in that table that all their projections made last March have been updated yet again in June to show somewhat higher interest rates and longer-lasting inflation than they previously thought. This kind of uprating has been the case every single quarter since their fourth quarter of 2021 report. Higher rates for longer means more braking on the economy, and they indicate they expect more than a full % higher unemployment from the current 3.7% as a long-term consequence for 2023 through 2025. Very tepid GDP growth was anticipated in this chart as well, but the Fed has now publicly stated elsewhere that they project the U.S. to enter recession later this year, and we'll show you charts that verify that from the Cleveland Fed. Their previous March projections were proclaimed to be effectively unchanged from the December ones at the end of last year, but close examination showed that the most hawkish FOMC members had increased their hawkishness. The new June dot plot shows that the terminal rate expectations among all the FOMC members jumped significantly in the quarter, up a full 0.5%, which still translates into continuing expectations for higher rates this year. Federal Reserve recession probability still reading very high, with a significant GDP decline in 2024. So if you look at the table that is shown in our written report, you'll see that the terminal rate that the Fed projected in March was 5.1%. Now it's 5.6%. So that means another 0.5% bump should occur within this year. In the energy picture, at the beginning of April, OPEC and Russia agreed to an additional 1.2 million barrels per day in production cuts to support prices for their oil. The markets responded by moving oil up over $80 a barrel again, but that lasted for only 2 weeks, and then oil collapsed by 17% to below $70, rebounding a bit back into the low 70s. Since then, that has been the basic range for WTI, or West Texas Intermediate crude, $67 to $75 a barrel. We'll keep an eye on global demand forecasts to see where oil could go over the next several months, but our expected volatile range for the next several months is $65 to $80 a barrel. Gasoline prices only pushed north of $4 a gallon in a few regions this spring, as a higher than usual number of refineries entered maintenance shutdown periods, but have been generally moderated by declining crude prices. So the probability of high gasoline prices for the summer should have been moderated, but a significant price break for gasoline still hasn't materialized. When it does, we would expect to see average pricing move nearer to $3 than to $4. There's a lot of yin and yang in the market forces that determine natural gas prices, but for now, they have generally declined significantly from high levels seen at the end of last summer. Production has overtaken demand again, and that should also relieve electric power production costs as natural gas accounts for about 40% of the U.S. generation mix. The first 5 months of 2023 saw solar and wind power generate more electricity than coal did, as coal-fired generation declined further, with renewables and gas-fired plants making up the difference. The Energy Information Agency has issued their own projections for declining gas and electricity prices in the near future, which are likely to take place as gas supplies continue to increase. Another mild winter ahead could send natural gas prices back down to historic lows. In the equities markets, early February of 2022, we gave an extreme risk warning for equities as the Fed was preparing to begin their quantitative tightening program that March. Here in June of 2023, there is continuing ongoing evidence of moves to cash as reflected in the money market deposits and the long-term bond markets. People are realizing the resolve of the Fed in their long game plan against the inflation dragon. However, this month's pause by the Fed encouraged a belief by some that the Fed program was done. Above, as we just mentioned, we showed solid evidence that they are anything but done. The recent bond trends reflect many more Treasury instrument purchases at the long end of the yield curve, which had continued to accelerate the 3-month versus 10-year yield spread through May, ending on par with records set in 1980. Fresh news in the form of 339,000 new jobs and a skipped Fed rate bump brought some life back into equities. These events are likely to not temper the Fed's action to quell inflation, however. We continue to expect a few more interest rate increases and then further general declines in equities and bonds in the intermediate term. A return from the current index level just below bubble territory to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 3,000. However, if the S&P 500 stays above 4,300 in the next month or two, it would be returning to exceptionally high-risk bubble territory. As the Fed states they are still highly resolute in their attack on inflation, that means significant rate hikes should still be expected, beginning with the next one about 6 weeks after the release of this report. They have clearly stated what their targets are, that inflation has not fully responded as needed, and they are dead set against pausing or quitting their program too early so as to avoid the mistakes made last in the 1970s. Further increases in interest rates should eventually translate into a decline in equity prices. Analysts are focusing on a return to earnings growth in the fourth quarter of this year, but if you look at the year in its entirety, earnings for 2023 will be unchanged from 2022, and they are no excuse in the picture of market valuation for a re-entry into bubble territory. More than half of the earnings growth for the fourth quarter is expected to come from just 4 companies in the S&P 500: Meta, NVIDIA, Alphabet, and Amazon. This is per FactSet's most recent earnings outlook report. So our comment in the chart below that we have posted for several months, which states that we believe analysts' expectations for earnings and revenue growth in calendar year 2023 was way too optimistic. And that will bear out now if the current set of analyst projections for the year play out as they think. The major idea here is that at this point in a business cycle, view analyst expectations very skeptically. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric which appear ahead of real economic downturns. The March number for this metric was up a bit by 3.4%, but it fell again in April by minus 2.1%. Equity traders are mistakenly thinking the Fed may be done with its program of rate increases. Risk capital has clearly made some serious exits from the markets, down 39%. An equity bottom an equity market bottom may be near on a historical basis when margin borrowing declines a full 50 to 55% from its previous high. So there's still the potential for a further decline of around $110 to $150 billion to realize the full decline from the last high of $1.03 trillion in margin borrowing. We'll create an updated version of the margin borrowing chart with fresh April through June numbers in our next report. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.